everybody. Brian here for quantlabs.net. Want to do this yesterday. Very important news item from Bloomberg. Search for yield is alive and well. What's going on in the markets right now is everyone knows that the markets are turning for the negative. The Trump trade seems to be, or Trump rally seems to be coming to an end. So what's happening right now is, if you look at this article, there's a search for yield outside of the markets, out of the S&P 500 or the U.S. markets. Oddly enough, there's better returns in Asia markets, specifically probably Hong Kong. Anyways, so here we are, more yield coming out of junk bonds, not good. How long can you go on European credit debt yield? Not much going on there. I mean, Europe's been pretty well dead. But here it is. Global bond risk premia hit multi-year low. Now, what I want to highlight here is if you see where that little circle is, and then here in 2007, 8, and 9, it peaked. Now, if you look between the periods of 2002, let's say, all the way up to 2007, there's complacency. When you look at this same period, it's a little choppy, but there's somewhat some complacency going on there. What's going on there is, as the professionals are looking for yield, what they plan to do is to package up, at this time, do things like the housing market was on fire, so they package up mortgage-backed securities, sell them as a valuable asset, pop goes the weasel, down comes the market, and that's what happened in 08. That's pretty well, in summary, what happened. So here we are in 2000, start around 12 to now, where it's going lower. More and more people are looking for yield. So when you look at this time span to here, this is where the markets go crazy. Not for the right reasons, not for the reasons that we know, but because somebody comes along and tries to do something that fools the markets, which led pretty well the financial crisis. But here, what you got to understand is back in this time period, debt level was nowhere near as high as it is now. That's for the U.S. government at $20+ trillion. So if this pop goes, we don't know where the next pop will go in terms of how it will play out. I don't think the government will be able to sit there and use itself as a backstop like it did in 08, 09. So I wanted to show that to you. Premium squeeze for emerging bond markets. Now, this was an interesting one because what's happening is a lot of the emerging markets, namely in Asia, they'll issue debt issued in U.S. dollars. And as the U.S. dollar goes up, which is probably not something that Trump wants to have, but if the U.S. dollar goes up, that's going to start to squeeze out a lot of the emerging markets because their debt has been issued in U.S. dollars. So it's better for them to have their debt lower with the lower U.S. dollar because it does directly tie back to the U.S. dollar. So that needs to be understood, and that's why there's a squeeze because the U.S. dollar could be looming for another rise. Now, here's another one. U.S. Treasury term premium is back below zero. So, as we all know, the Treasury has been hovering around 2% there, as you can see, back in 08, 09, and it's now pretty well at zero. This is where, if anything, in terms of things that will be the catalyst to basically unleash the tsunami wave that they've been talking about, I predict, and I think a lot of other people will predict, that once U.S. Treasury hits zero, I can guarantee you that's when the markets will start to react and react in such a big way it will change a lot of people's lives. So these are the sort of things you need to be looking out for. So look what's happening here. Investors change tune and stop demanding extra compensation. There's another thought here as well, because if the bond holders that are not the holders, the people that are buying up U.S. debt, namely, they want to be paid extra more for taking on the risk of a potential default. I'm not saying default will happen anytime soon, but once you get those treasury yields hitting zero, that's when you have to get a little, no, actually not worried, panic. And here, what we have here is because the yield's so low that investors are now no longer taking premium on Treasury yield like they used to, extra premium to take on that debt and the risk of it because they're very, very desperate. Now, next chart, stocks more expensive relative to bonds. So even though your returns are decent for the U.S., let's say S&P or any of the other U.S. indices, what's happening here is, God, I gotta readjust here. What's happening here is that the S&P equity risk is climbing versus holding bond because there's a higher yield in bond. Right now, that's the way the market's turning. So a lot of hot money is moving back into bonds, namely U.S., as the markets change for the negative possibly, or at least maybe even range bound. And again, they need to take that hot money and move it somewhere. So a lot of it's going into bonds, but there's really not a lot of yield on bonds as well. But once they start to increase the rates at the Fed level, I'm sure that obviously we'll get a better yield. Now here's where the desperation comes in, because here you have search for yield on a search engine like Google. So back in November 03, they were looking for yield. Back in 07, 08, and then here it is, right there, just before sometime in, I'll say June. Nobody's getting any yield. So that's what's happening in the markets with all these other charts that I showed off here. And I think it's really important to be aware of that. And the one thing I would be looking out for moving ahead is Treasury yield, and specifically around the U.S., because that's going to be the marker where people are no longer going to buy up U.S. debt, which the Chinese and Japanese have been dumping. And oddly enough, some other countries like Ireland are pretty strong at buying up the U.S. debt. But at the end of the day, once that Treasury hits zero, I don't think it will because the rates are going up. So who knows what will happen in the markets. But there is going to be, the house of cards will come down. I just don't know what will be the catalyst or the trigger of that. But thought enough it'd be interesting to put this together for y'all, and make sure you do check out this article on Bloomberg that you can easily search for 7 charts that show search for yield is live and well. Over and out.